International Monetary Fund has released its regional economic outlook for Sub-Saharan Africa. It's titled Living on the Edge and describes the concerning economic condition that the Sub-Saharan region finds itself in amidst a number of macroeconomic headwinds. Joining us to discuss further is the IMF Representative for Nigeria, economist Ari Aisen. Ari, good afternoon to you. Thank you so much for joining us. It's great to have you.
Good afternoon, Rotus. It's such a pleasure to be here with you today.
Indeed. It's good to see you. So as we look at your outlook, I think you've gone from Sub-Sahara 4.6% GDP growth last year. You've projected a downgrade of 3.6. Can you talk us through the reasons for that? What you call, I think, was an interruption to the recovery. Can you talk us through that?
Yes, 2020 was the year of COVID-19. And then the economies of our region were recovering very well in 2021 because there was kind of a large contraction, in fact, in 2020, including in Nigeria. And that recovery was starting. But then, in the beginning of 2022, we had the war in Ukraine. And that has had a strong effect on the economic activity globally. We also had an inflation increase worldwide and tightened monetary policy throughout 2022. So that was a difficult year, 2022, and it's likely, unfortunately, to continue challenging in 2023. So we say that it's an interruption because we were in the path of a recovery in 2021 that was stopped or interrupted at least in the next this year and next with the additional shocks and the monetary policy tightening in the global economy.
Wow. There's a whole lot to get into in the report. How big of a headwind is inflation? Nigeria, for instance, we got double-digit inflation. You talk about it in the report. How big of a headwind is inflation for the sub-Saharan economies?
So inflation has really increased, not only in sub-Saharan Africa, but globally. And it's way above the median over the past several years. Just to give you an example, inflation now in Nigeria is at 17-year highs. So we are in 21% year-on-year inflation last month from the National Bureau of Statistics information. And that has to be tackled, seriously. And I think that the authorities have already started to take this challenge head on. By tightening policies, particularly monetary policy, who needs to see it right through. And we've seen the central bank tightening rates this year by 500 basis points. It may need to go further if inflation doesn't decelerate. Let's remember that inflation, it's a tax on the poor. The poorest people pay the highest burden on this inflation, which is like a tax on their money, the money that they hold. And they don't seek refuge or any potential safety for the resources. They cannot, for example, the banking system, many of them don't have access to banks and financial services. So inflation punish those particularly strongly. So it's a very important economic policy objective to reduce inflation and bring it to levels that are sustainable, much lower and stable.
Thank you for that, Ari. What about public debt? You also talk about debt in the report. How much of a headwind is debt for these sub-Saharan African nations?
Yes, unfortunately, we have debt has increased significantly. It's now at levels over 60, 70%, in some cases even higher. That need even restructuring in the region. Some countries are engaging with creditors, and we are trying to facilitate these discussions as much as we can. But in several countries, the debt to GDP ratio has returned to levels pre-HIPC. HIPC was the high indebted poor countries, and many African countries got that relief because the debt level was very high. So now we have come back a little bit because of the shocks and because of debt creation over the several years, again at a very high level of debt in several countries, and many unfortunately are at high level of debt, and several, I think 6 countries in the region already are in debt distress, meaning that they need to restructure their debt positions.
How much of an appetite do you think there is for debt forgiveness with this current climate?
You think the problem with that is and candidly speaking, that first of all, it's important to understand what countries are doing with the debt that they issue.
Right.
It's very important that a country or even a household or a firm issues debt, that the proceeds that are invested bear good fruits and returns, so tax revenues in this case, for example, can increase and repay the debt service. If you keep accumulating debt, but the fruits of the debt that was issued do not bring those returns, then the debt can accumulate to a situation that it becomes difficult to service properly. So my intuition is that before even discussing opportunities of debt relief, also the landscape of that has changed substantially. You have many creditors that in the 2000s did not exist, or they were minor. Now you have Euro bonds. So many creditors, debts are disseminated among various bondholders in this case.
Yeah.
So it's not as simple to look at debt relief as it was. It was never simple, but certainly more complex these days. It's very important to engage with commercial creditors. It's very important to understand why debt was actually created and why suddenly creditors must pay for governments that, for example, perhaps did not use those debt proceeds in the way that the countries needed. So there are many associated aspects to this: governance, debt management, that needs to be very clear, needs to be taking into account all available debts, and several countries in the region that was not very transparent. Right. So it's very important to make sure that all the debts are there and accounted for. So negotiations on restructuring for those countries who need can take place, and that should all precede efforts to eliminate that or give that forgiveness. Because I think otherwise we will just replicate.
Just keeps growing, exactly.
And we will do in next years will be the same time. I think it's important to reflect on it and take lessons on how countries should operate with that.
Thank you so much for that, Ari. The report, let's take a look, has 4 policy recommendations that you make, if you can, to walk us through. So I think you've got, addressing food insecurity, managing the shift in monetary policy, consolidating public finance, and setting the stage for greener growth. Can you talk us a little bit through each of them?
Yes. The first top priority is food insecurity. Morally is the right thing to do, that, without food on the table, particularly for children, nothing can happen after that. And from an economic development point of view, if a child doesn't eat until the age of 3, even 5 properly, then that child will never grow into a productive adult. So we take this very seriously, and addressing that will require mod food production. For that, prices need to be high enough for suppliers of food to be enticed to produce more. That's a supply response. On the other hand, because food prices being high may hurt the vulnerable and poor, you need actually clear channels at which you can use mechanisms to protect those vulnerable. Cash transfers that need to identify those who need the most, rather than universal type of protection that typically protect more those who have already resources than the poor.
Yeah.
So I think it's very important, we think it's very important that we look into the vulnerable, clearly register those as much as possible, and protect those that are affected by high food prices. So this is one aspect. Another aspect is that the second priority, fiscal consolidation, because fiscal space was used to fight previous shocks, the pandemic and the war in Ukraine. Now we need to consolidate so fiscal deficits can be reduced. So one way of doing that is raising tax revenues.
Gotcha.
Particularly in countries where spending is very limited, like Nigeria, we think that revenue mobilization is existential. It's going to be critical to resolve the problem of deficits that, if they continue to grow, they will lead to debt to increase further and further. So it's going to be very important to consolidate in the case of Nigeria, not by reducing spending, but by raising revenues. Of course, if you take few subsidies, that will be one category to be eliminating here in Nigeria, because simply it costs 2% of GDP plus a little more. And it's going not to the most vulnerable. But so the Nigerians need to come together and take that decision firmly soon, because this is just bleeding the fiscal accounts of the country. So this is what we are supporting. So the consolidation should happen on the fiscal accounts to protect the debt position, and also, frankly, to avoid a situation where the central bank needs to come in and finance part of the deficit, which is inflationary. So the third priority is monetary policy. Because inflation is high, monetary policy will need to be tightened in several countries, particularly those with very high inflation rate and not with very clear monetary frameworks. So in that situation, you really need to try to rein on liquidity. Reining liquidity may be very large in the economy. So there is no other alternative really to tighten interest rates. For those countries that still have a very fragile recovery, maybe a more gradual process could be contemplated. But the fight against inflation should be very serious by central banks. Typically, central banks take that task very seriously, because providing the primacy of price stability, as we say, the priority objective of central banks, it's really to make sure that inflation doesn't run away. And you can see that inflation is high, not only because of supply shocks, food prices and energy, also various categories in the basket of goods in Nigeria and elsewhere are also increasing in price. When you see that core inflation increasing, it's becoming more disseminated, and it makes the job of the central bank even more difficult if they wait too long. So I think that the Central Bank of Nigeria started to take action seriously on rates. It needs to also phase out some of the quasi-fiscal initiatives, credits to the private sector, and it needs to come back more, our view, to the inflation fight. And for that, you need to reduce the liquidity in the system and mop up and make sure that credit doesn't grow at very high rates as it's growing now.
Fantastic. Real quick, Ari, we've got about a minute to go. I wanted you to talk about the impact of, because the report says GDP growth is important. A potential of GDP growth can actually increase while reduce debts to some degree. Can you quickly talk about that?
Because what is important is the debt to GDP ratio. So if your debt is increasing, but the GDP is also growing at similar rates, the debt to GDP ratio is not growing, because numerator and denominator are growing. In that sense, you can still keep at a level that is sustainable. So it's very important to get growth. We should never forget that growth is important. More important is that the debt that is financing the growth can bring the fruits through this growth process, so revenues can increase and service the debt. So you actually continue to be solvent with the debt to GDP ratio that is stable or even declining in some cases is needed, but also in terms of liquidity, that you have enough revenues to service your debt, which now in the case of Nigeria is taking a bigger portion of the pool of revenues. So the way to handle that, it's more a symptom of the low revenues than of the high debt, because Nigeria debt position is moderate for now, and the debt service is taking a big share of the revenues. If the revenues were grower, that share would be much smaller, so debt service would not inflict huge constraints for the fiscal space and the fiscal accounts of the country. So in the case of Nigeria, of course, continue to control the debt position, but raise revenues. Revenues is very important. Also to be able to do the spending that is needed on health, education, nutrition, and you need more resources for those.
Ari Aisen, we have to have you back. This is a great report. I wish we had more time to get more into it, but we really appreciate you coming on here to break it down. IMF Representative, of course, for Nigeria, Senior Economist Ari Aisen, thank you so much for joining us.
It's a pleasure to be here. Thank you.